Ladies and gentlemen, welcome back to Driven Wyld. Today we are talking about reducing your taxable income as a gig worker. So we all know that gig workers have the opportunity to reduce our taxable income with some of the options that are available to us. And it is easy for us to say that we can reduce our taxable income, and it's easy for us to say that we have a lot of tax benefits as gig workers, but what does that actually mean? So with that said, we are talking about everything you must know about reducing your taxable income as a gig worker, some of the strategies that you could use to owe less money, and everything in between. But before we do that, let's go over a quick disclaimer. The content of this video does not contain, is never intended to be, legal, business, financial, tax, or health advice of any kind. This video is for entertainment purposes only. It is advised that you conduct your own research and consult qualified professionals before applying anything you find online. Also, thank you to GigTax for verifying this information and making this video possible. Plan throughout the year for taxes. You know the old saying that proper planning prevents poor performance? Well, this is part of it. During the course of the year, one of the things you should be considering is a proper plan and strategy for your taxes.
But Joe, gig workers don't know what they're going to make from a day-to-day basis. So how is that gonna work?
Well, let's go through it. Let's start with at the beginning of the year. It may seem early, but having a proactive mindset will be worth it when it comes time to file. The sooner you start preparing for the next tax season, the better. You're gonna have more flexibility to pursue tax strategies that could potentially benefit you. This is also a great time to decide on and develop your exit strategies, because the gig economy is an income bridge to what would be a long-term goal and not the goal. But regardless of whatever exit strategy you use, you will also need a tax strategy for that. Now let's talk about during the year really quick. Now that we have made it past a few months of the year, you made it past January, February, March, now you just made it past April tax season overall, you might want to consider reevaluating your tax strategy to see if you're on track. I know that the first few months of the year for gig workers is rather slow. And it's also smart to contribute to other retirement funds and implement other tax strategies like that to reduce your taxable income along the way. Also, you should have some funds set aside for yourself in the event that you need to pay back some of your taxes. You have the means to do so. Now, most experts state that you should set aside 30% of your income for taxes, whereas Joseph Mayo, the founder of GigTax, claims that this is wildly conservative. Depending on your state's income tax level, W-2 income, if any, and other credits that you may be eligible for, you may only need to set aside 15% of your income, which would allow you more disposable income throughout the year. So make sure you discuss with your tax professional on what is best for you. By the way, GigTax is offering free consultations to help you determine if you're on track to meet your tax liabilities in advance of the next tax seasons, but more on them later. Finally, let's talk about the end of year. We made it past May, we made it past June, we made it past July, at the end of August, coming into September. Revisiting and considering your year-end tax strategies may help you identify any final opportunities to reduce your tax bill. Have you ever wondered why the fiscal year of most companies is at the end of August and the next one begins in September? That's part of it. And not to mention, for us as gig workers, the holiday season is a huge time for us, which means you may realize that you're able to contribute more of your pre-tax assets to your 401k at year's end, helping to reduce your taxable income. Speaking of, contribute to your retirement accounts. Contributing to your retirement accounts can be both beneficial for both your long-term financial health and your near-term tax bill. Here are some ways that contributions to your retirement accounts can help you achieve tax savings. A traditional 401k. Because of your contributions are withdrawn from your paycheck before you've paid taxes, your taxable income will be lower, potentially reducing the federal taxes you owe at the end of the year. This could be especially important to consider if your income straddles tax brackets. For gig workers and the self-employed as a whole, there are also a self-employed version of the 401k, so you might want to look into that. Traditional IRA. Contributions may be tax deductible depending on your income level and whether or not you have a retirement plan option at work. Personally, however, I am a proponent of the next one, the Roth IRA, which are funded with after-tax dollars, so the contributions won't lower your immediate tax bill, but you will benefit from tax-free distributions in retirement if certain conditions are met. Contribute to your HSA. So this one might be a little bit more challenging for gig workers, especially with the lack of benefits that gig workers tend to have, but an HSA can be greatly beneficial to you if you qualify for it. If you're in a high deductible health plan or HDHA, you might qualify for a health savings account or an HSA. Per IRS guidelines, an HDHP is a health insurance plan with a deductible of at least $1,600 if you have an individual plan, or a deductible of at least $3,200 if you have a family plan. This deductible is the amount you'll pay out of pocket for medical expenses before your insurance pays for anything. They are also a lot more affordable, so if you're looking for a health plan at all, it may be a good option for you. And if you do decide to do that, consider increasing your contributions to your HSA. Your contributions will be pre-tax, which will reduce your taxable income today. This account can also grow tax deferred, and distributions can be tax-free if certain conditions are met, which makes this account the only account with a triple tax benefit. Qualified charitable distribution. This is for the senior gig worker community. If you are 70 and a half years or older and would like to support a charity, consider making a qualified charitable distribution for up to $100,000. Directly from an IRA to a qualified charity. A QDC keeps IRA distributions from impacting your adjusted gross income, or AGI, now and in the future. It works whether you take the standard deduction or itemized deductions, and it can count towards your required minimum distribution if you have one.
But Joe, aren't all charitable contributions tax deductible?
Yes, and there are exceptions to that as well, but this is separate because it's straight from a retirement account. You can also deduct the amount of other donations you've made by 20 to 60% of your AGI, but I'll go deeper into that in another video. Maximize your deductions. A tax deduction reduces your taxable income. Consider whether the standard deduction or itemized deductions may be most beneficial based on your circumstances. If you're planning to itemize, instead of taking the standard deduction, consider how you can take the early steps to maximize the tax benefit by taking advantage of tax deductions that are only available to those who itemize. For some self-employed individuals, some deductions to consider are qualified charitable gifts, unreimbursed medical and dental expenses that exceed 7.5% of your adjusted gross income, and your mortgage interest deduction. For gig workers specifically, deductions to consider are home office, vehicle cost and maintenance, and other business supplies such as hot bags, wagons, and car chargers. Leverage available tax credits. Tax credits work differently from simple deductions, where a deduction is based on a percentage of which you can write off in a lot of cases, whereas a tax credit can reduce your liability dollar for dollar. To ensure that you're not missing new credits from the government, review potential credits available to you on a yearly basis. Great example of this is the Inflation Reduction Act that offers tax credits for taxpayers who make a purchase for a qualified electric vehicle or make certain energy improvements to their homes. You can check with the IRS website for available tax credits as well as in your state, and make sure that you look into tax credits for individuals and businesses because you may qualify for both ends of that. Tax loss harvesting. If you've experienced any investing losses, they could potentially become tax saving opportunities through a strategy called tax loss harvesting. When executed properly, tax loss harvesting allows you to manage and reduce your tax burden by selling investments at a loss to offset the taxes owed on capital gains and other investments. In summary, it's one way to use the tax code to to reduce the sting of an investment loss. However, this strategy can be a little complex to employ, so make sure you reach out to your financial advisor or tax professional for personalized guidance. Harvesting capital gains. On the opposite spectrum we have harvesting your capital gains, which the next couple of years may be an optimal time to do that, thanks to the temporarily lower tax brackets. Here's why. In 2017, the Tax Cuts and Jobs Act temporarily reduced income taxes and brackets throughout the end of 2025. As of the recording of this video, there hasn't been a law to extend this yet. And barring a new law that extends these rates, it's worth considering strategic opportunities to sell certain assets that haven't experienced capital gains yet. If executed properly, you could potentially pay taxes on the gains under more favorable tax brackets. Your next tax bill may be higher due to a sale, but in the long run, you may realize that greater tax savings than if you sell when tax brackets return to their pre-2017 levels. Like tax loss harvesting, this is a complex strategy, so make sure you reach out to your financial advisor or tax professional on whether or not this opportunity is right for your unique situation. Family members. Now, this one has a lot of options available to you. Hiring a family member is one of the best ways small businesses can reduce their taxes. There are a variety of options that the IRS allows for this. You can even hire your children to shelter your income from taxes. Income paid to your children has a lower marginal rate, and sometimes the tax is eliminated altogether. If your business is under sole proprietorship, your child's wages are exempt from Social Security and Medicare taxes. Just make sure that the earnings are justifiable for business purposes. Meanwhile, hiring a spouse would also reduce your taxes since the earnings are not subject to the Federal Unemployment Tax Act.
But Joe, gig workers don't have that option because they can't contract out their accounts. So how would that work for us?
First off, that is yet another reason for you to develop exit strategy, because the gig economy is an income bridge to what would be a long-term goal and not just the goal. And second, the answer to your question really depends on the strategy itself, which is why you should consult with your tax professionals. There are many laws and intricacies associated with business taxes, and you don't want to risk overlooking something important when it comes to your taxable account. You may be able to tap into health savings or write off a qualifying child care expense. However, it's also very important to consult with a tax professional that won't overcharge you for having as many 1099s as gig workers tend to accumulate, which is why it's so important for you to choose the right tax professional, and GigTax is here to help. Filing your taxes on time, promptly, and accurately is an inevitable aspect of being in business for yourself. For every hour spent on navigating tax season alone, you miss out on potential earnings, precious moments with loved ones, and expose yourself to financial risks. Recognized as the leading tax preparation service for gig workers, GigTax is dedicated to simplifying the process, saving you time, energy, and money. Founded by Joseph Mayo, a seasoned gig worker with over 6,000 deliveries across 6 platforms since 2020, GigTax addresses the overlooked, overcharged, and underserved needs of gig workers in the financial realm. Driven Wyld subscribers can take advantage of an exclusive 77% discount on GigTax's tax prep, bringing the price from $538 to $124. Act now to get this price locked in before GigTax's calendar is booked, because GigTax helps those like you make the wisest and most effective decisions on your business and personal tax needs all year round. Secure your spot today with GigTax using the description link below to their Instagram page. Slide into his DMs with the word wild and get back to what you do best, making the most amount of money in the least amount of time in the safest possible way. Thank you so much for watching. I really appreciate it. As always, make sure to hit the like button, subscribe if you're new, and I'll see you guys next time. Peace.